We are here to talk about the digital asset infrastructure and how it's fixing Wall Street. Like it or not, finance is being changed and digitally transformed by the disruption of the status quo. We've seen a substantial shift in the financial sector. Traditional banking and financial systems are being disrupted by digital innovations. A lot of it thanks to many of you guys here on the panel today, and is shaping a new landscape that is meant to be more accessible, efficient, and transparent. So I want to ask you, gentlemen, if we look at the state of the financial markets today, how is it, bearing in mind everything that we've seen through the end of last year, what is it that wasn't good enough for addressing economic inequalities, inefficiencies, and instabilities in traditional markets that's being changed by Web3 and digital assets and blockchain infrastructure? Why wasn't Web2 and fintech good enough?
So, if you, solving inequality, so I'm saying solving inequality and those kind of issues are much broader, and there are many factors at play. But certainly where Web3 comes into picture is that it enables market access. For instance, there's a protocol called Credix that enables someone to be able to access credit opportunities in LATAM while you are sitting in a developed market. So I think those kind of opportunities are only possible if you are able to use stable coins and crypto rails. That's one example. The other example I would say is your ability to program money and stable coins, right? 5 years ago, 10 years ago, if a certain country had inflation problems, and if you are not one of the rich, it's very difficult to find a way to hedge your net worth, right? You could only buy or protect your capital in deploying in gold and art and other kind of forms of assets which are not easily accessible to everyone.
Right.
But something like stable coins, what they enable is a fungible way to transfer your net worth into currencies and assets that you can hold on to and be convinced that I'll not lose my hard-earned money because of inflation. So these are the things that, in my view, Web3 enables.
Pat, you seem to agree here. You're nodding your head.
Yeah, I do. I'll take a step back. From an institutional standpoint, the benefits are very apparent in terms of transparency, lower costs, zero counterparty risk, which for the financial markets will be tremendous. And that's why the movement of real world assets into tokenization, eventually into some type of trading on a 24/7 basis globally is just so exciting. But those are the big three: transparency, lower costs, is almost zero or zero counterparty risk with atomic swaps. Now, just to add to the earlier comments, I was part of MakerDAO, which was a major DeFi protocol.
Right.
And it's all about fractionalization and access to third world countries, et cetera. One of my colleagues there, actually, his name's Mariano Conti, and he became somewhat famous in this whole crypto DeFi world because he wrote about this. But he still lives in Argentina, and Argentina's had very high inflation. He was paid in stablecoin. He was paid in DAI as a part of MakerDAO. And so he was able to convert that DAI to USDC at no cost. So he was being compensated basically in US dollars, but by utilizing a stablecoin bridge. So, along the lines of what we've talked about, a lot of that is happening on a global basis. Very exciting.
Mrinal, with the digital payments market is somewhere around 99.9 billion with an expected growth to about 303 by 2030. How do you see these broken elements in traditional finance? Like, what are they specifically that are being fixed or that are being addressed in the current markets?
Yeah, the two things that I think are broken in current financial systems are One, overhead, and the second is transparency. And both of these lend themselves really, really well to blockchain technology. So let's talk about overhead. I'll use an example. If you take a typical core banking system that reconciles a bank's portfolio of mortgages, these are Frankensteinian old school systems. It requires a lot of analog input and output on top of it. And the costs to actually reconcile the average mortgage bleeds, mortgages are a basis points business, and it bleeds tons of margin off of it. Now, if you're able to put all of that on a blockchain system, which also had a financial primitive standard, like say those done at Actis, you've basically taken a system that has tons of overhead, eliminated a ton of it, and made it a lot more secure. Because if anything, what blockchain is best at is making something tamper-proof and knowing that it's been copy protected. So overhead is one large area where blockchain can really help.
Right.
The other place is transparency, because if you think about it, the reason the 2008 financial crisis happened, the reason Silicon Valley Bank happened, et cetera, is people weren't able to accurately assess the risk within their portfolios because there wasn't a linear tamper-proof data structure. Now, as with any system, garbage in, garbage out, I'm not saying like if we just cobble together some blockchain thing, magically everything's transparent. It's going to take work. It's going to be a large retooling. But if we set up our financial systems in a way that we have great look-through into risk, we could mitigate and avoid problems like the financial crises we've seen.
Right. So, it's really interesting with Alex, you started your career on the sell side. I know risk management now on sitting on the buy side in Abu Dhabi, I think you have a different take on it. But this idea of risk management with digital assets, the common thread through the history of your career was really this fascination with how digital assets can be applied or digital payment infrastructure applied to mitigate that risk. How do we reconcile that with, not just the state of where financial markets are, but even, the current, all the stuff that's making the news, I think, in the digital asset industry? What makes you, why are you here, Alex? What fires you up still about it? You're a risk guy on the sell side. Walk me through the risks.
Thank you very much, Mona. So I would be honest with you, risk was a large part of my portfolio, but valuation was another very big issue. And I think that right now we actually can marry the two in order to get something which is a little bit better, maybe a lot better than the existing system. I would say that the fractional reserve banking, the way it evolved over a period of 300 to 500 years, is currently undergoing a phase transition to something rather unexpected. So essentially, if I were to be a betting man, I would say that the very existence of fractional reserve bank in the era of Twitter is endangered just because Twitters and social media more generally can cause uncontrolled outflow of liquidity from essentially any lender. And it's not necessarily just, say, regional banks or banks tightly geared toward a particular market. It can actually cover big international banks, like, for instance, there was attempt to destabilize the Deutsche Bank, which actually, from what I can see from way outside, seemed to be in a reasonable shape, yet there was a concerted attack on it through social media. So essentially what we see is that the right-hand side, the liability side of the balance sheet of a typical bank became much more liquid, whilst the left-hand side, the asset side, actually became quite illiquid because of the quantitative tightening, if anything, if nothing else, right? So basically it makes this two-sided balance sheet extremely ill-suited to the vagaries of fractional reserve banking. So what we really need to do is to somewhat make the liability side a bit more viscous, and the asset side a bit more liquid by creating a secondary market for the bank assets. And that can only be done in an efficient way through tokenization. So basically, you have to tokenize assets of banks if you want to preserve some elements of the fractional reserve banking. And you have to split essentially banking activity into narrow banking, which is essentially just payment banking, and investment pools. And for that side, you actually do need a stable coin or even better central bank digital currency. So I would say that these risks, which were undervalued until recently, come to the fore. And the only meaningful resolution which I can think of is through tokenization and creating, at the very least, stable coins. But if stable coins were to become an important ingredient in solving this puzzle, then of course they have to be built to the highest possible standard, which is not so easy. In fact, if you wish, without going into any specific detail, I was talking 2 days before the Silicon Valley Bank debacle to a CEO of a large stable coin undertaking, and I was asking him precisely where the collateral is and what will happen if a bank which holds his collateral were to collapse. And the gentleman told me that all is good, and they are in good hands, and so on and so forth. And then surprise, surprise, before the end of the week, this happens. So you see what I'm saying? We really need to rebuild the fractional reserve banking system, and the only way to do it through tokenization of both assets and, if you wish, the underlying currency as well.
So that you're a betting man, Gautam. What do you make of that?
So look, I think what's really interesting, what's going on is that, what internet did to retail and completely transformed how people purchase stuff online, how disintermediation happens. There was only so much internet could do to banking and financial services. I think, as Professor mentioned, that with blockchain, you effectively have a new tech stack that's being experimented on in parallel with our existing very old banking rails and banking tech stack. So we are now seeing some of the value that you can get out of blockchain, whether it's through tokenization, which you couldn't solve this fractionalized reserve banking model without thinking of a way to, have liquid assets that can trade, right? So this parallel blockchain tech stack, where you can play around with these kind of concepts like stable coins, asset tokenization, 24/7 access. You can play around with that and then implement all of that in the existing banking rails and to enhance that. So I believe that this is the internet moment for banking and financial services. And we can effectively do all the experiments on the blockchain on the side and then implement that on the main banking rails.
I mean, there are a lot of calls in the industry. Why should markets stop? It's sort of nonsensical if Robinhood is out there saying that markets should be open 24/7 and you've got to wait 6 days for a bank wire, or you've got to, right? Or when a market actually opens, it doesn't make sense. And we do see a lot of movement from countries or consortiums of countries that are looking at developing digital currencies. We've got BRICS is on the menu, Saudi Arabia, Brazil, El Salvador. We've got MiCA in the EU and the UK. And Mrinal, you've studied this. You've studied really what people's perceptions are, because one of the things that we do know is that in the UK, crypto laws are now being categorized by definition. So we're coming up with taxonomies, and we're looking at things like, is it lottery and gambling? These laws that are being discussed are kind of coming to a standstill. In the United States, we know that our policymakers and lawmakers are asking for self-custodied wallets to have federal identifications. And I learned from you yesterday a shocking statistic that 86% of fund managers don't differentiate or distinguish between blockchain and cryptocurrency. So as we're looking to create these these centralized digital coins, or we're looking at creating these tokenized economies, where are we regionally in different regions in terms of defining what we're talking about? If we can't, what does the future look like for us here?
Yeah, unfortunately, regionally, and again, I might be missing out some, but amongst developed economies, I think there's only about 3 that have very, very well put out laws. That would be Switzerland, specifically Zug, the United Arab Emirates, and Singapore. So I'm not saying that the laws are lax. In fact, they're very, very strict, but they're very, very clear, meaning in Switzerland, you know exactly what's a utility, what's a security, what's a payment token. Wishful thinking would be that most countries in the world look at these 3 and follow their pattern, meaning even if you disagree with what their laws are and you want to be stricter, at least give people clarity. I think the biggest issue we have in a lot of countries in the EU and the United States is not that the laws are strict or not strict. The issue is that there's just no regulatory clarity. You know, if you tell entrepreneurs you're allowed to do this and you're not allowed to do that, most people will act well and fall within those rules. But if you don't know what the rules are, it gets exceedingly tough. And I think the United States might be chasing innovation outside the country unless they are a little more specific about it.
Pat, what are you?
Well, I have a completely different view, but I'm a banker by background, and Oasis Pro, and I have DeFi cred with MakerDAO. So maybe a step back so everyone knows what Oasis Pro is. We actually are regulated and compliance oriented, and one of our subsidiaries called Oasis Pro Markets. We're a trading venue. We have a digital blockchain for exempt securities, OTC securities, funds, lots of different things. And for instance, Filecoin yesterday by the SEC was deemed, if you're familiar with that, that's a crypto, a security here in the U.S. We could list that on our ATS if we wanted to, just as an example. I disagree, and I've been in this market a long time, and I'm a banker by background, Credit Suisse, Bear, so I was always in a regulated industry. The rules have always been there. We're part of we've been with the lobbyists here in the U.S. trying to go down the regulation light area, but my DNA is I've never seen the U.S. markets, SEC, FINRA, CFTC, go regulation light on any security or commodity. I've never seen it. And so there was hope that of this asset class going down that path, but our approach was always assume it's not going to happen. And fortunately or unfortunately, that's the direction it's going right now. So I think the rules are here. And I think the rules are going to get stronger. The SEC is moving quickly. They're actually approving more ATSs. So they're actually trying to get this market going by recent actions. It is regulation by enforcement, but I'm originally from Italy, but I grew up in the United States. To me, the U.S. is very resilient, and I've been all over the world, and I've never seen a product leave the U.S. that the U.S. didn't want to see leave. As soon as the market's open here, it could be 5-10 years. I would expect everybody to come back to the U.S. And that's what I've seen across the board. So I'm a bit of a pragmatist.
Yeah, so walk us through that bull case. Like, if you see it taking 5-10 years, there's a gap. I mean, this is something that Gautam is talking about, and we hear about it from Hester, we hear about it from Senator Lummis in the United States, where they're saying, what about the innovation drain? That will be the advantage of other markets. So what's the bull case, and how does it fix? What's the U.S. bull case, and how will it fix and digitally transform markets? You see it going out and then coming back because it's America?
Well, look, MiCA in Europe is not strong legislation for crypto. Anybody in the crypto industry looks at it. It's stablecoin, it's great, but at least there's some guidance. But it's really not very good legislation if you're a crypto maximalist at all. So I think what the U.S. is going to do is go down the path. And one other comment where I am a real bull, but this is very quiet, so you don't see this in the news, et cetera, is that they're going to see what all these other institutions do, away from the politicians saying we should do what Switzerland does. Here in the U.S., they're doing that. They're pointing at Switzerland or MiCA or some of these other as examples. But I've never seen, again, the U.S. following other countries, more of being a lead. So what I believe will happen is they're going to see what works and what doesn't work, but when they make the move, it's going to be all in. It's going to be a tidal wave here in the US. Now, our focus, we do a lot of things. We do tokenization, we have a TA, we have an API management dashboard for large infrastructure products. That's our real focus. We have a marketplace and an ATS, many subsidiaries. But we're working with the largest institutions in the world, one of the largest multi-center banks, some of the largest investment banks, largest custodians on an integration path. And they have hundreds of people just working on blockchain right now. It's all about blockchain, permissioned, eventually public blockchains as well. And they wouldn't be spending all these efforts, from my perspective, unless they believe that eventually the US will get there. They're not lobbying, but when they turn on that spigot of lobbying, when they have it done internally, I think that's the bull case. That's why I'm so excited.
Gautam, what do you think about the opportunities that we see in this sort of, while America's defining itself?
Yeah, look, the good thing about digital assets and crypto is it's a global asset, right? It's hard to say
Regional.
a particular region would not be able to participate.
Yeah.
And yes, there will be phases when some regulatory clarity will be needed and sought in different regions. And eventually, as Pat mentioned, it's hard to believe that 10 years out, you have the world interacting with digital assets and blockchain, and US is not a significant part of it, right?
Sure.
But yes, what we are seeing in the short term is especially as an asset manager, there's a data that came out last month where it shows the proportion of VC investments by region. And what's interesting is that Q1 2022, US was 70%, Europe was 6%. And Q1 2023, Europe is 47% of that. For sure, the pie has shrunk, but the proportion of founders in Europe has gone up quite drastically. Now, some of them would have moved from different regions, all of those would happen, but I just cannot believe that you will not have digital assets everywhere in the world and blockchain everywhere in the world.
Fair enough. And so, Alex, we heard great announcement. We heard a big piece of news from Coinbase in Abu Dhabi last week. We know that in the EU, if we look at just exchanges, right? We're in a place where we have active market exchange. We know that in the EU, one of the definitions or discussions is that exchanges will be liable for customer losses. This is something that's being debated within the EU framework. And Abu Dhabi is the name of the game these days when people talk about where they're going to next. How do you put that in context for the opportunity that you see for a regional play in digital assets? And again, fellas, how are we fixing broken economies, emerging markets, and banks? How does this help bridge that?
Okay. Well, to answer your question is, as gentlemen already said, digital assets by their very nature are very international and cross-border by design in many instances, not always, but in many instances. And so from that perspective, having regulatory clarity is extremely important. And if basically there is at least one jurisdiction or several jurisdictions which are favorable to this type of assets, and by no means I mean lax, but more like well-defined, well spelled out, well thought through, these jurisdictions will inevitably attract exchanges, attract trading companies, and in general, companies which try to tokenize assets. It's a very natural thing. So in many respects, this movement towards our part of the world is due to the concerted effort by the regulatory bodies to create an environment where people can do things with a modicum of certainty, which might be lacking in other parts of the world. But at the same time, I would agree with other speakers that, of course, the US is a huge chunk of the world economy, and it sooner or later these developments will come back to these shores, and the digital economy will start to thrive. As far as how it can fix the banking, I already mentioned how it can be fixed other parts of the economic landscape. Well, it's a little bit more nuanced. So I would say, from my perspective, what is interesting is tokenization of private equity, liquid assets more generally, right? So infrastructure and things like that, and opening them for members of the society to invest directly. So I would say, as was discussed actually yesterday in another panel, things which are not really liquid, it's hard to liquefy them. But yet, I would say that a modicum of liquidity and, more importantly, accessibility could be achieved through this tokenization. I already mentioned a bank asset. It's a very specialized area where, in fact, having a two-sided market between the private banks on the other side and the central bank on the other side is, in fact, imperative. And it has to be done in an environment where there is a the two-sided market. It's very important to have two-sided market. But that can be by extension expanded towards other other assets, right? So where maybe the thing is not so much the need to immediately liquefy things, but more like to provide greater accessibility. And of course, in those parts of the world where there is a great danger of hyperinflation and general instability and things like that, the possibility of leaving a little bit the local currency in favor of international currencies seem to be quite attractive. Argentina was already mentioned, but it's not only Argentina.
Right.
Having said that, and I will finish right now, is that we need to be cognizant of the fact that digital assets do not live in the ether, forgive the pun. Basically, they also have physical elements to it, and people seldom appreciate the fact that if a government of a particular country doesn't really want to do things this way, they can just shut the internet, right? So from that perspective, make no mistake, Bitcoin is not a source of wealth of the last resort, because if, God forbid, and it comes to this point, the internet itself would be in great danger, right? So you see. Anyway, so that's what I want to say.
I think we have to wrap up here, sadly, gentlemen. We could keep going. There's a lot I wanted to talk to you about automation and some of the ways that digital assets will help fix that. But final thoughts here. Digital assets are here to stay. What are they going to do in their wake? How are they making systems better?
Yeah, just quick thoughts. Like, I think I would split this what's going on in blockchain and digital assets in two parts, right? One is how can we use blockchain technology to better our existing infrastructure? Mm-hmm. And I think, as I mentioned, blockchain has that ability to reinvent the tech stack that we are used to in the financial services. Yeah. And we are seeing the value out of that. And then the second part of that is new innovation, new use cases that will actually enable through blockchain. And that's where cryptocurrencies and crypto assets kind of play a role. So I think we need to figure out a way to split these two in the way we approach this space.
You think we will? Soon-ish?
I think we are already doing it.
We're doing it. All right, Gautam. Yes, Pat.
So I'm old enough to remember when the internet started and mobile phones. And the internet, when it started, was basically news articles and shopping. And mobile phones were a flip phone. Now it's completely different. I think we're not even in the early stages. I think we're in the incubacy stages of blockchain. And separate crypto and blockchain. They're two different things. Crypto is on blockchain. The usage opportunities that have already been discussed today of blockchain, we're only touching the surface. I mean, trade finance, fractionalization, two-sided markets in the illiquid positions. All these things we're talking about today, But in 10 years, it's going to grow exponentially. So it's definitely here to stay. But to me, the aha moment was separating the two. The applications of blockchain, very similar to AI. AI is going to, obviously that's not the purpose of this panel, but that's going to take things potentially even further than blockchain. But that's how we view blockchain, and the benefits completely outweigh any of the downside. And the biggest issue with blockchain is you can't build it on legacy. So that's part of the slowdown, especially in capital markets. But with APIs, et cetera, it's starting to move at this point. But very bullish.
Mrinal, final thoughts.
I agree with everything that's been said so far, so I won't repeat that. Just to add one more point. So as a result of blockchain making financial systems much more secure in a cheaper manner, as well as much more transparent, I think one of the biggest effects we'll see is something that Dr. Lipton talked about, which is things that were once illiquid can now become liquid. And a really good example is what we did with IPW. So us and IBM helped IPW build this patent marketplace. And if you think about it, Porsche, for example, the value of their patent portfolio, sometimes some people say probably exceeds their market capitalization.
Right.
So there's this massive set of illiquid assets, in this case patents, that exist that are not being monetized or reconciled appropriately. And so I think that's going to be huge. So whether it's patents, land deeds, art, I do think things that are typically thought of as illiquid are going to become highly liquid going forward. That'll be interesting.
Well, as far as I'm concerned, I'm a big believer that sooner or later this technology would actually prove its worth and fulfill its promise. And in fact, it probably will happen within the next 5 to 10 years. And the big things which I kind of can envision is that finally we should be able to fulfill the original TPS-IP internet protocols, where there were actually holding places for identity and money, which were never filled. And now, by many experimental efforts and hard work by many people, we should be able to accomplish this, because we do need digital money in this digital era. So I think that the potential is huge, and it's already happening in many respects. Maybe things are not as visible as they were originally promised, but I think that with perseverance and a clear goal in mind, we should be able to get there.
There you go. Thank you.